Hello, my friends. Today is July 6th, and this is Markets Weekly. So, this past week, we had a shortened holiday week due to the 4th of July, but when markets were trading, they were basically going up, and we closed the week at new all-time highs. Today, I want to talk about three things. First, I want to talk about why I'm very cautious on the stock market right now, despite being on team crash up. Secondly, I think the big news the past week was all political news. And that's really important because, remember, markets are downstream from politics. So let's talk about how it seems that the establishment is collapsing across the Western world. And lastly, let's talk a little bit about the housing market because there are more and more signs that the housing market is definitely slowing, but no sign of a collapse. Okay, starting with the stock market. So when I look at the stock market, it looks like the S&P 500 and the NASDAQ are going to the moon, going up every single day. And, some might even say that they are going parabolic. Now, when I see this is very concerning to me because it tells me there's a lot of speculation and a lot of leverage in the market. Anecdotally, I get the sense that there are more and more retail involvement in the market, and leverage today is not margin debt, which is what it used to be. Leverage today is options, specifically call options. And as we all know, there's a lot of call options activity in the market. Now, this sets up for a market that's very fragile because you have a lot of people all on one side of the boat, all highly levered. A slight, setback, a slight external shock could really have a downward cascading effect in this context, and this is something that we see over and over again throughout history across the world. So I'm very positive on the stock market. As you guys all know, I'm on team crash up, and I think that we are going to go higher than anyone expects. I've been telling everyone that for several months, but that just doesn't mean going up every single day. If we keep going up like this, we have a high risk that we could overheat and then have a downward cascade where the correction goes further than you would expect and longer than you would expect. So I think the best scenario for the market right now is if we cool off a bit, pull back a bit, consolidate, and then we can go back up again. But right now, I don't like what I'm seeing. Now, just looking across the world, let's say looking at Euroland, over the past few years, we had a global equity market rally. We went up, they went up, and right now, over the past few months, if you look at the stock market indexes in the UK and France and Germany, they've basically been stalling to consolidating over the past few months. If you want to look at other indicators of risk sentiment, let's look at crypto. Now, Bitcoin had a really bad week, but if you look at the altcoins, they are having an even worse week. Now, over the past few years, I've noticed that crypto seems to be the most sensitive risk-on asset, and it's not been doing very well. Now, looking at the news the past week, it looks like the biggest bear on Wall Street, JP Morgan's Marco, is leaving the firm. There are no more bears on Wall Street. So again, I'm looking at this, the totality of it, and I'm getting the sense that we are probably at close to some kind of tipping point where we're probably going to get some kind of correction. I've been saying this for a couple of weeks, been totally wrong, but I'm sticking to this. So again, I'm very cautious on the market right now. I'm seeing a bit too much euphoria. All right. Now, the second thing I want to talk about is the big political developments we've seen the past week. Again, this is really important because the government is the most important actor in the economy, in the markets. What fiscal policy does, what monetary policy does, in my view, these are the most important factors that shape price action. So last week, we talked about how Biden's poor performance at the debate shifted the odds in favor of a Trump presidency, and so many Trump trades were running. We saw prison stocks surge. We saw longer-dated interest rates go up a bit. Now, this past week, we had some new developments on the political front. Right now, the markets are actually thinking that it's more likely that the Democratic Party nominee will be Kamala Harris instead of President Biden. And interestingly, despite this pretty big development, markets are still pricing in, about a 60% chance of a Trump victory this November. So it doesn't seem to have a big market impact so far. But I'm getting the sense that the market is probably a bit too complacent about a Trump victory because there's a good chance that maybe Vice President Harris just won't be the nominee. And if we have other people emerge, say Gretchen Whitmer or Gavin Newsom, I think the odds become a lot less difficult to place going into November. Now, at the moment, President Biden is still quite adamant that he will not leave. He's going to be the nominee, but we also see forces gathering within the Democratic Party that are trying to push him out. Notably, very big name donors are saying that they don't want to donate to President Biden, thinking that it's a lost cause. Again, without money, it's very hard to run a campaign. And you also have Democrats within Congress trying to push President Biden out. Like we mentioned last week, politics is a team sport. If you have an unpopular president at the top of the ticket, everyone down ticket is going to suffer. So a lot of these guys are thinking that, well, if Biden's going to be the nominee, it's going to impact my chances of getting elected in the House or in the Senate. And so they don't like that. So again, I think the betting markets are right that President Biden will not be the nominee. But beyond that, I think we're going to be in for a few more weeks of turmoil. It's going to be very exciting. And I think that it's a risk factor for the markets in the US. But I think the big election the past week was what happened in the UK. What we're seeing is the complete destruction of the Tory, which is the right-leaning party in the UK. They absolutely got swept out of office. So right now we're seeing the Labour Party, which is the more left-leaning party in the UK, take a majority in their legislature, which is going to give them a lot of power to carry out their agenda. Now, markets are actually pretty complacent about this. Part of it was probably because it was expected, but also part of it is that, the division between the Tories and the Labour are not as polarized as they are, let's say, in France or in the US. Now, the big problems confronting the UK government, of course, like everywhere else in the world, inflation. People are unhappy that their living standards are declining. They're unhappy about social services. For example, healthcare in the in the UK, you famously have to wait a long time before being able to see a doctor. And of course, migration has surged in the UK like it has in many other countries. And a lot of people are feeling uneasy about this, and it's straining social services as well. Now, Labour, well, they're going to have a lot of challenges they have to confront. What they do seem to be very clear about is they want to build a lot more houses to alleviate the housing shortage. And so that seems to be very friendly to home builder stocks in the UK. But of course, the big news, of course, in the Europe is the upcoming French elections tomorrow, Sunday. Like we discussed last week, there was a chance, well, there still is a chance of just the rise to power of the right-leaning Rassemblement National, which has a very different vision for France. But political developments over the past week have made Rassemblement National majority much less likely in France, and so I think that's calmed markets a bit. So let's have a little bit of an overview about how this election process works. First, of course, in France, you have 2 rounds of elections. First round, and then you have a legislator. First round election, a lot of people run. And then you have a second round where you basically have a runoff. But in the event that a third party also did very well in the first round, you could still have a 3-way election on the second round. Now, what happened the past week was that the left-leaning party, Nouveau Front Populaire, and the more centrist party, Macron's party, basically got together, and they are trying to push out the right-leaning party by saying, hey, if there's an election where either the Front Populaire is third or Macron's party is third place, we're just going to bow out and we're going to tell our members to vote against the Rassemblement National. So if you look at the data, you can see that for a lot of these districts, for a lot of these districts where the Rassemblement National had a plurality of the votes, The second and third place votes were not that far behind, but when you combine them together, the second and third place runner-ups, so basically people who belong to either the left-leaning party or the center party, together is enough to push out the first place winning Rassemblement National candidate. Now, if their plan works, then that really makes it very difficult for the right-leaning party to gain a majority control in a legislature and thus form a government and push through their agenda. Now, polling seems to suggest that it's very, very unlikely for the right-leaning party to gain power. And so it seems like the most likely outcome tomorrow, Sunday, is that you're going to have a fragmented legislature, which means that nothing gets done. And I guess it's more markets friendly and there's less huge deficit spending, less big changes in the legislative agenda. But again, this is highly uncertain and there's going to be a lot of strategic voting. It's easy to see how left-leaning parties can band together to defeat right-leaning parties, but I think it's a little bit less certain whether or not the center will actually go and vote for the left instead of for the right. I think some people in the center are very uneasy with the economic policies of the left-leaning parties over there. But so far, markets have taken comfort into the reduced probability of a big change in direction of the legislator, which is what you would see if the Rassemblement National rose to power. So let's see what happens on Sunday. Again, tail risks are diminished, but we can always have a surprise. Polling is difficult for the second round. Okay, the last thing that I want to talk about is what we seem to be seeing is a slowing housing market. Now, housing has been super resilient all throughout this rate hiking cycle. Many people thought that the future would look like the past. Again, we had a housing crash in 2008. Many people thought that when mortgage rates went to 7%, and they've been at 7% for some time, that housing market would completely tank. That did not happen at all. In fact, housing prices gradually rose. But now we're seeing some definite softness in the housing market. First, let's look at the upcoming supply for houses. Now, the leading indicator for this was single housing building permits, construction starts, and you're seeing that indeed there has been a significant drop-off in applications to build new single-family homes. Again, that's a strong sign that housing activity is slowing. Now, the reason for this seems to be that the builders have just an enormous inventory of new homes that they're trying to sell. Now, new home inventories are at levels last seen since pre-Great Financial Crisis, pre-2008. So it seems to be that builders saw that they were having tremendous demand for their product, built a lot, but have been having trouble selling them, possibly be due to higher mortgage rates impacting affordability. And so they're just kind of slowing down since they have a lot of inventory. And that seems to be causing some anecdotal softness in prices. Now, looking around, I'm hearing more and more that at the very least, prices are not going up for new construction. And in some places, they're declining a bit. Now, of course, housing is very local. Nationally, we still see home prices continue to rise, but it does seem that they are softening a bit. In addition to this, again, supply and demand, looking at the demand side, we still have very high mortgage rates, but we also have very clear softening of the labor market. Now, over the past few months, the unemployment rate has steadily ticked up again this past month, about 4.1%. And in line with the softening labor market, we also see wages decelerating. Now, wage growth is still very healthy, but it's been decelerating for months. And as people have slower wage gains, as mortgage rates remain very high, naturally, they're not going to be able to afford very high house prices. And so what seems to be happening is that the builders are meeting them with a slightly lower or at least stagnant home prices. Now, this doesn't mean that the builders are not doing well. When you look at the earnings reports of the builders, well, they still have very high margins. Looking at KB Homes, for example, which is a builder for, the lower side part of the market, their margins have surged over the past several years. Now, they don't seem to be in distress at all. what seems to be is that they have some degree of pricing power. So rather than just keep increasing the supply of homes and just take market share, they're happy with their position now. If you look at the home builder stocks, they surged the past few months. They've been coming down a bit, but they're still quite high. So it doesn't seem like there's any sign of a crash, no signs of distress from the major builders. And again, looking at home buyers, whereas there's an affordability issue, unemployment still remains strong. So it seems like the housing market is set to correct sideways over the coming months. And if we do have, let's say for whatever reason, rates come down a bit, in part due to Fed cuts, or maybe more concern of a global economic slowdown, you can see those mortgage rates come down to a 6 handle, and maybe that would be supportive of things as well. Again, the future is not always like the past. There's no indication of a housing market crash, but what we do see, though, is a lot of softening in the housing market that would be good for people looking to buy a new home. All right, so that's all I prepared for this week. Again, not much happening the past week. And if you're interested in hearing more about my thoughts, check out my blog at fedguy.com. And if you're interested in learning more about how markets work, check out my courses at centralbanking101.com. Talk to you all next week.